Hey guys, Sean here. Earlier this year, Jerome Powell vowed to fight inflation and he had two weapons. Now, the first is to raise interest rates, and he has been doing it, raising rates from 0 to 2.5%. And the second tool he had was quantitative tightening. Basically, he wants to reduce the Fed's bloated balance sheet and start selling off their assets. And if we take a look, we can see how horrendous it is. The Fed bought over $5 trillion worth of bonds and securities over the last 2 years, and this is one of the big reasons why you have such an insane inflation rate today. Now, in May, Powell drew a plan saying that from June to August, the Fed will start reducing their balance sheet by $42.5 billion a month and double it to $95 billion a month from September onwards. That means it will take at least 4 to 5 years to drain the swamp of funny money if we go full throttle. But something weird has happened. This deleveraging is not happening fast enough. The Fed is not walking the talk, and this is flying past the radar of many investors just staring at the interest rates. And I think we really need to pay attention over here. So if we take a look at the Fed's balance sheet on the 1st of June, we see they have 8.915 trillion on their books. And if we fast forward to the latest update, which is the 21st, the Fed still has 8.899 trillion. And that means the Fed only has reduced their balance sheet by $16 billion, a far cry from the original 42.5 figure. Something is up. There's a good chance that the Fed is caught between a rock and a hard place. Powell is realizing they are caught, and if they continue to tighten, they could really crash the economy and plunge it deeper into recession. Now, this is very worrying for you and me because we could be at a turning point. Right now, it is a battle between inflation and a recession. The Fed is waiting to see which is the bigger threat, because once they pull the trigger and start flooding the market with their assets, this will cause a deadly spiral that will send rates to the moon and grind the economy to a halt. But first, we need to understand what quantitative tightening or QT is. Now, the Fed only has two avenues when it comes to reducing their balance sheet. The first is to redeem their securities and let them run off. Now, this is a slow process, which I suspect is what they're doing right now. They are afraid to make big moves. Now, the second method is to directly go to the open market and start selling their bonds or mortgage-backed securities. This is the more aggressive move. They won't need to wait for their assets to mature. They can immediately pull out cash from the economy for them. So when we see that only 16 billion has been reduced, it means the other 8.899 trillion is being reinvested back into treasury bonds and mortgage securities. The Fed has to roll them over to the following months. Now, the big question is, why isn't the Fed reducing all the way by $42.5 billion in June, right? Because if they can't do that today, they sure as hell aren't going to start slashing their balance sheet by $95 billion from September onwards. Now, this is a very bad sign, it's a very bad omen, because the Fed realizes that they can't, and now they have one hand tied behind their backs when it comes to fighting inflation. Now, we have to investigate further. Why can't the Fed tighten to the max? Why can't they aggressively sell off their balance sheet to bring down inflation? Perhaps it's because the Fed is sitting on a mountain of losses. They have over 330 billion in unrealized losses on both their treasuries and MBS, and it's because they bought a ton of bonds during 2020 at rock bottom rates. And now that interest rates are rising, their securities are worth much less. In fact, it is estimated that once short-term rates reach 4%, they will be operating at a loss of 62 billion or 150% of the Fed's total capital. Now, you might be wondering, how does it even affect the Fed, right? After all, they can just print money to get themselves out of this mess, right? Well, not exactly. In reality, the Federal Reserve is beholden to the Treasury when it comes to earnings, right? So according to the Brookings Institute, the Fed has been enjoying positive earnings income for the last 10 years, and they have been funneling the profits back to the Treasury. But in this high interest rate environment, all this is about to change. Now, many of us don't really realize that the Fed also has expenses, and that is paying off commercial banks whose money is parked with them. If we take a look at the reserve balances with the Federal Reserve banks, we can see that commercial banks have deposited over $3.2 trillion. And this means that the Fed has to service interest payments on these deposits. And guess what? Every time they hike rates, these payments become more and more expensive. So the big banks are doing this because they know rates are rising, they know asset prices are most probably going to continue collapsing, and this is a risk-free way to earn money. After all, technically the Fed can never default, right? They can literally print money. So Powell is in an interest rate squeeze. The higher the rates go, the more they owe commercial banks, and if they sell off their securities, it will just cause interest rates to fly up even further. Because remember, when you sell bonds, You reduce the price and you jack up the yields, so the Fed is technically caught, and that is why they have only sold $16 billion so far. But there is an interesting admission by the Fed on their operating losses. They admitted they'll still be able to operate, but their payments to the Treasury will be suspended and the deferred asset will be recorded on the Fed's balance sheet. So basically, if they were forced to sell their bonds and realize this loss, they can essentially carve out the losses and turn them into a kind of an IOU asset. However, this IOU will still need to be settled down the road, and this will come out from any money going into the treasury in the future. From this chart, we can see that the higher interest rates go, the Fed's net income becomes more negative and the longer it takes to recover. Now the orange line shows just a hike in 1% interest rates, but now the Fed has hiked rates by almost 2.5% in total, and that means its net income losses are really starting to pile up, and it probably won't be until 2026 until things start to recover. And this means if the Fed book their loss, the Treasury will get zero income, they will get nothing from the Fed, and they are not able to help finance government spending, which is already getting out of control, right? And this leads us to two dangerous options. Either the US government reduces their spending, which will send the economy into a deeper recession, or they borrow more money and blow up the deficit even further. And we know the end game of that, right? Higher inflation down the road and an even bigger crash in the years ahead is just kicking the can down the road. Right now, it's becoming clearer that the Fed can't unwind their balance sheet without a major disaster happening. With the recent 75 basis points hike by Powell, if they do sell their assets, it will just skyrocket rates even further. Right now, we are seeing tough talk from Powell saying that inflation is the number one enemy and there will be no surrender in this battle. And if this is true, if he's really going to go all the way by reducing the balance sheet, this could just collapse the market. On one hand, you will have rates going to the moon, and on the other, the Fed will have to book in horrific losses on their balance sheet, and the Treasury won't have any income for years to come. But there seems to be little wiggle room for Powell because right now he has to fight inflation. 9.1% CPI in June is not a good look, guys. Remember that the Fed has a dual mandate of stable prices and maximum employment, and right now, unemployment is near all-time lows of 3.6% today. So the pressing problem, at least on the surface, is inflation, and it's very possible the Fed could pull the trigger and start selling off bonds to hike rates even faster. So the big question is, which is the more disturbing threat to the economy? Is it inflation that is making everyone gradually poorer, or is it a recession that will cause massive layoffs and a slowdown? And that is why I believe the Fed and Janet Yellen are trying to downplay the severity of the upcoming GDP numbers. They are desperately trying to redefine what a recession is, because if they don't, and everyone is really panicking on the streets, everyone's screaming out there, it's going to be impossible to reduce their balance sheet. And this leaves us in a very bad position. The food and oil crisis really isn't getting any better. Russia seems to be toying around with Europe's gas supply, and the only way left forward is to crush demand, right? You can only influence the demand side of the equation now. There are a lot of dangerous economic factors in play today. We have lower consumer spending, companies' earnings going down, and rates heading up. Plus, if we throw this balance sheet QT problem into the mix, this will quickly become a black box on how everything will play out. Now, the arguments for both a Fed pivot and a deleveraging are both equally strong. If the Fed chickens out and pivot, we could be seeing a temporary bottom in the markets. Now, if they go, okay, there's enough damage to the economy, it's time to stop the rate hikes and even start cutting rates, then we'll likely see a strong rally up. It's the equivalent of the Fed declaring victory. However, if inflation continues to clocking at record numbers, 8, 9 or even 10% in the months to come, and if Biden's approval ratings continues to plummet because of inflation, the Fed has no choice but to crush inflation by employing their nuclear option. They could really start to seriously unwind their balance sheet and start selling their treasuries and MBS aggressively in the open market. And let's think about it. Do they care if they suffer massive losses? Probably not. What if the US Treasury suffers in terms of income? Doesn't matter, right? They can always borrow more money and kick the can down the road. So both options are equally possible, and we cannot underestimate the Fed's ability to maintain a bloated balance sheet or the government to borrow endlessly, because as long as the US dollar is the reserve currency, they can do anything they want in the short term. And this is why dollar cost averaging is the time-tested method for investing, right? Because there's no way anyone can predict what the Fed is about to do. We have no idea if they're panicking, crying, or laughing behind closed doors. things could really continue to crash for months to come, or we might be reaching a true bottom very soon. I think we need to pay close attention to how the Fed is going to handle their balance sheet, because if they really start deleveraging as promised, this could collapse the house of cards. There's really a lot to take in, and I think the most immediate situation is to realize that we can't time the markets. The Fed is trying to calm the situation, telling everyone the economy is strong, and it's probably because they don't want to sell their bonds. They don't want to book a loss, reduce revenue to the treasury, and hike rates even further. That's the triple whammy if they really start selling assets as promised. And that's why personally, I'm still averaging to the markets even as they crash. I'm buying value stocks, dividend paying stocks, and gold because I want to catch that upswing if the Fed chickens out and hyperinflates us to infinity. Right now, the market seems to have been pricing in the recent rate hike. The S&P rallied above 4,000, showing that investors believe that the Fed can't hike anymore, or at least the economy is still stable enough. But we have to watch how this situation unfolds, because there are going to be a lot of events that might shock the economy down the road. We are seeing a relief rally going on now, even though tech earnings have missed estimates. We saw big names like Microsoft and Google climb by 6 to 7%, and that means a lot of the bearishness perhaps have been already priced in, and the market believes that inflation is going to be tackled. They believe inflation is the greater enemy versus rising interest rates. But the big question is whether this is the calm before the storm. Are company earnings going to crash in December as all our savings get depleted? And if that happens, will the Fed crash the markets even more to defeat inflation once and for all? Now, these are very tough questions that only a crystal ball can answer. So hang tight, guys, and let me know what you think. Are we nearing a bottom, or is this just a false rally? Will the Fed finally decide to reduce their balance sheet and crash the markets to fight inflation? Let me know in the comments below. Stay safe, and if you enjoyed today's video, be sure to smash the like button and subscribe as we navigate through this market insanity. Thank you guys for watching, and I'll see you soon.